All right, looks like we're at 4:30. We're going to go ahead and get started. This has been the longest hiatus that I've had in a while. Been running hard, but I've been off the last 4 weeks. So we're going to get right down to it. And for those of you that have not been on this call before, basically since COVID had hit, what I tried to do is a monthly rear view mirror look as to what I see happening in the marketplace and sort of take a thoughtful look versus a reactionary approach towards our finances on a go forward. And as we progress, and we're entering into unseen waters. We've got a lot going on. Geopolitical risk is always ever present. It seems that in the Middle East, some things have started to flare up. Prayers to all the families out there. Just be careful. I had one of my friends, Kung Fu brothers, actually literally drove me to the airport and was driving to take he and his girlfriend to Israel when they got bombed. He was fortunate; he's now home safely, but it is just an absolute awful scenario. But I just wanted to say that as we go through this, if anything I say resonates, you have questions, there are things you can do to reduce some of the risks that are out there ever present in the marketplace. And typically, the news likes to feed on two things: fear and greed. So those two recipes can typically cause you to miss out on, returns over time. And so when you have strategies, when you have a plan, you can make thoughtful decisions and be comfortable that as you move forward, that you got, a strategy in place that'll help you to reduce a lot of the risk. So without further ado, let's get into equities. So the growth indices for the month of September. September was not a great month in and of itself. And as we look at the different indices, you see that commodities, right, sort of was the least affected, and we're going to get into why. Oil prices have I think finished up the month of September at around $90 a barrel, and a lot of the commodity linked indices are heavily oil laden, so that makes sense. And you'll see how it started to be a place where people are starting to look to try and get returns. But all the other indices for the month of September, I think we from this point last year, it was down 6%. So it's something to be noticed. But overall for the year, most of the indices were about even. But notice that commodities, that gold right in the middle, and that sort of makes sense because oil has started to rebound, and as I said, it's approaching now $100 a barrel. And so as those things start to happen, people start to look at less favorable ETFs and start to move into arenas that they think will continue in that direction. So that's one of my observations. But overall, the S&P for the year is up. But like I said, September as a whole was down from the beginning of September to the end of September. And like I said, I think it finished down about 6%. And now as we go forward, we look and say, hey, where should our money be? Where should we be looking towards? There's a lot of, it's always speculation, right? And that's why diversification is so important. You cannot predict markets. When we invest in strategies, ETFs, we try and take a thoughtful approach. If you remember, a lot of our philosophy is around a core investment philosophy that is risk appropriate to the folks that are looking to put money in place, right? So that's first and foremost. And then what we can typically do is bolt on satellites, right? And we're going to start to talk more about that as the year wraps up, about how to start to say, okay, I have this core strategy in place, but there are other areas, structured notes, principal protected notes. Brookstone has come out with some strategies, multi-sector bond indexes, or indexes that they actually call BAM indexes, which are looking at automating some of the structured notes or the notes in general on how to add those to your portfolio. They are not meant to be a standalone typically, but they are designed to help us to smooth out and give us diversification so we can start to smooth out a lot of these wiggly lines. I know I just spewed out a lot of information very quickly, but if you've been on my calls before, you'll start to understand how it's important to me that I repeat things and hopefully in an easy to understand fashion. Now, the charts here as we as we move forward, we have the top. This is what I call the three wise men. It's a sort of a we've edited from what we used to show in the past. They've gone to Y charts to give us more current data. It doesn't go back as far in time as the last charts that we used. But that top line, right, is monthly average indicator, and it takes the 3-month average of the index, in this case the S&P, and it measures that against the 12-month or the blue line. And you can see that that green line that is here all the way to the right, when these three signals happened, right, that was saying, hey, we tend to be in an upward trend. It's not all-knowing. It is not giving investment advice. It's just one of the technical indicators that we look at to be able to say, hey, this is something to pay attention to see what the environment is showing us. Now, the next two, right, RSI is a relative strength index, and the MACD is a moving average convergence and divergence indicator. Both of these indicators are momentum indicators, and they just offer different bits of information so that as we're looking at things and we say, hey, can we forecast where we think the market is moving, and sort of the analogy that I give here is sort of like it's like a bellwether on your house, or maybe a windmill, right? That is, not only is it telling you that the wind is blowing, but the direction that it's blowing. And so those types of signals in the investment arena can be used as an idea so that we're not reactionary. Because if we were to put on the news right now, again, it's either fear or greed is typically the topic of the day. And I like to teach the folks that I deal with, a little bit more of a well thought out, calmer approach towards investing to help as much as possible to remove some of the emotions that are typically associated with investing. Now, the next slide I put here first. I thought I put this here. Maybe I did not. Okay, yes, I did. So this is the income. So let's think about this logically, right? Is if you're in retirement, part of the strategies, quite often it has been promoted in the financial planning arena, is that we want to create an income stream. So these are all income indices. Now, notice at the bottom, the 20-year treasury. Now, the 20-year treasury was reintroduced back in 2020, but it's had a falling off. But it's starting to get some traction again, and people are starting to look at, some of that longer term money. But overall, if you hold a bond portfolio in your current, holdings, you can see here that your value may have come down. So what does that mean? And quite often, usually when I'm teaching this, it's to somebody that's already participating in something at a 401k at work, a 403b at work, a TSP, or some type of balanced portfolio, which is good, right? We want diversification, we want equities, and we want bond holdings, because typically over the past, they tend to balance each other, offset some of the risk. But what's going on now is unlike anything we've seen, and that's that sometimes we're seeing not only do the stocks go down, but sometimes bonds go down as well. And so if that's happening, one of the questions that quite often will happen is why? And remember, when we're thinking about bond prices, if interest rates rise, which is we've been in a rising interest rate environment for the last few months now, right? And I mean, mortgage rates I just looked up are now have just hit 8%. So I was on with a young couple this morning, and they were saying, yeah, we're probably going to be looking to buy a house next year. So how does a young couple buy anything? Because those people don't have 200, 300, 400, $500,000 to go put down on a house. So they have to go get a mortgage. And this is the Fed and the government's attempt to stem inflation. Housing prices have been through the roof. And so when prices fall, which is why if you look at your 401k statement, you'll see, hey, my bond portfolio is down. However, CDs are up, yields are up, market rates are up. And that's because they have an inverse relationship. And I just wanted to go over that briefly before I go into the snapshot for the whole year. And the whole year says, hey, listen, if I was on a fixed income, although the valuation of my overall holdings may have gone down, the income stream that I could be withdrawing from that is actually increased. And again, in September, it was indicated that Jerome Powell would pause interest rates, at least in the near future. And then he came out this week and basically sort of said, hey, listen, I didn't raise them yet. It's still a possibility, another quarter point by the end of the year. So if these things happen and interest rates continue to get spiked up, we will see pressure on the overall valuation of our bond holdings. And the different ETFs affected across the globe are experiencing that as well. So that was really what I wanted to talk about today. I know it's been, 4 weeks, 5 weeks since I've done this. I'm back at it. I've been traveling. I was in Chicago, Kentucky, Vegas, Scottsdale. That coupled with a busy summer, I've been, a little bit MIA. But I am back. We're going to continue to build out content, at least for the next month, and then I got a couple more trips up. So continuing to trying to bring education and value to everybody. I've been getting a lot of people calling me saying, hey, what should we be doing? So if that's you on the call, if I can help in any way, let us know. The last thing I wanted to just show you is right now we still have a green line. So the 3 wise men for the income strategies is still showing that, this is right now. I know that I've said in the past, it looks like we're heading into a recession, but I still think one is on the horizon, but not by the end of the year. The only thing that causes me a little bit of concern is what's going on in the Middle East, what's going on between, God and the Gaza Strip and Israel and Iran is really the wild card, right? We're sending ships there. This is actually going on. And, and what was amazing to me is that I was talking to my 16-year-old and 14-year-old, and they had no idea until I brought it to their attention. Now I've finally started amongst a couple of their friends they were talking about, but here they are in school. Now, to the school's defense, my daughter did say her history teacher was out. But this is not a lot of times folks may not be aware of things that are going on, but that type of stuff can absolutely affect the markets. So, I'm not a gloom and doom type of advisor. I believe in being thoughtful and planning and having strategies that help mitigate a lot of the risks that's in the place. And whether that be geopolitical, whether that be, locally, whether it be inflation, unemployment, there's just so many variables that go into, but the signals do indicate we are still in recession territory. Remember, 50% is the number that is sort of like the middle of the road. And although we're down from our last month, we're still above 50. So like I said, I think it's, it's backed off. I don't think that it's inevitable, but again, I don't have a crystal ball, but that's just what the signals are telling us. That's what the gauges in the cockpit are telling us. So I just wanted to share that with everybody. hopefully that made sense. And again, we'll be back after this, be promoting this in the future, and glad to see everybody on. Stay well. And again, please don't keep me a secret, and we'll talk soon.